welcome everyone, and for you to come to this session. And in this seminar, we come back to the topic that we started this term. I think the whole year basically, and we come back to the topic on Chinese infrastructure investment. And but of course, we have a different perspective today, and our presenter is Alina, Dr. Alina Shoaib. So I actually do not need a note to introduce Alina, and Alina has done everything from SOAS. So she has done her master degree from SOAS, when I only came, well, after a few years I came. And then she had a break and she came back and wanted to do a PhD. So she started a PhD project. And at that time, that was the time when China was, I would say, at high day of Chinese infrastructure investment, overseas infrastructure investment. So we agreed on a topic, and Alina followed this direction. Alina produced a very careful PhD dissertation, and she's now working as a lecturer in a university. I think she's working very hard on preparing her chapters to submit, so that she can actually persuade actually a proper career. So that's what she has been doing, and I think this paper is based on one of her chapters, but it has been changed quite a lot since it has been a long journey. And I think Alina is teaching in a similar area as she was with us at SOAS. She taught some. Now that day, during that period, we had finance in China, for example. So she taught modules like China and in relation to the standard corporate finance theory or financial economics. So Alina, I'm so happy to see you. We are all very busy, but now we have you to talk about this paper, and I'm sure you have some new things that you will tell us. Are you ready, Alina?
Yeah. Thank you so much, Professor Bo, for your really nice introduction. So yes, we started this paper like a long time ago, and this is from my PhD, one of my PhD chapters, and we have changed this chapter a lot. For example, one of the major changes that we have made is that I was comparing 3 regions around that time, which was Africa, Europe, and BRI. But then we decided to change it to African and non-African countries, because BRI, from that time to now, BRI kind of includes all those countries which were in the African region. So we kind of changed it from Africa to non-African countries. So similarly, we have made other changes as well, and hopefully we can do something about this paper and publish it soon. So I will start with the background of Chinese infrastructure investment in general. So what has China been investing in globally? So the big number here from 2005 through to 2024, it is $2.5 trillion all across the globe. So you can see this is a huge amount of investment that China is making all across the globe. The biggest regions of investment have been Europe, which is around 500 billion, East Asia is around 400, West Asia 350, Sub-Saharan African is 350, and Middle East and North America is around 280 billion. So, however, there is more to these numbers that meets the eye. So this data that we have taken, it's taken from the Chinese Global Investment Tracker, which is from American Enterprise Institute and the Heritage Foundation. So the data is classified into has classified the overseas Chinese investment into two categories. One is the general investment, and the other is construction contracts. So the general investment, it includes all investment apart from any infrastructure type investment. For example, financial assets investment or government treasury bonds, shares in public listed company, etc. So this is general investment that China is making. And the second type of investment is primarily infrastructure type investment, um, which is the primary focus of our paper. So these are listed as construction contracts in the data. And this is anything from road projects, transportation, energy, any kind of projects which involve infrastructure investment. So if we look at the top 10 recipients of Chinese investment for general investment, um, these are primarily within the developed market. So it makes logical sense as these investment includes financial assets and treasury bonds, which are more aligned to developed financial markets. So these investments are like about $1.5 trillion of investment within the 2.5 of total investment was of this general investment from China. So if I give you some examples, Chem China acquired Syngenta in 2017, and the acquisition was for 43 billion. So this again is a very huge investment that China made. And there's another like Geely Auto Company. They invested 9 billion in Daimler, which is a German company, in 2018. Ping and a Chinese company, they invested around $10 billion in HSBC, which is a British bank, in 2017. So China has been investing um, a general investment in kind of mature market economies. But if we compare that to the construction contracts and Chinese Chinese infrastructure investment mainly, we can observe that the top 10 recipients of China's infrastructure investment are less developed or developing economies. So these are emerging economies as well. So you can see Nigeria, um, Saudi Arabia, Pakistan, UAE, Algeria, as well as Indonesia. So these are all the top 10 recipients, the top 5 recipients of Chinese construction investment. Now, 9.5 billion, for example, was spent on an energy project in Pakistan. Then 7 billion was spent on energy project again in Turkmenistan. And then there are several, 6 billion was spent on transport project in Algeria. So these are all kind of big investments that China is making. And these are in developing countries where there is a lack of infrastructure, let's say. Um, it's not necessary that these countries are poor, but for example, Saudi Arabia is not a poor country, but there is a gap of infrastructure um, in these areas. So in our focus, we are primarily going to in our paper, sorry, we are primarily going to focus on these kind of projects. So before we move on to our analysis, it may also be worth looking at the key sectors that these investments have been made into. So a cross-section of data for the BRI investment contracts, between 2013 to 2018, this suggests that around 75% of China's infrastructure investment goes into energy, transport, and real estate for the BRI contracts. So this means that China is mostly investing in sectors where they believe that mostly investing in countries which require projects such as energy or transport. So there is definitely a requirement for or a need for that or a gap in those kind of sectors. So if you see the regional distribution on the right hand side, um, Asia, South Asia, Africa, and Middle East is kind of catching up, and Asia and Africa are in the top. Again, the sectors that have been invested in are energy and transport mainly. So when we think about this background, we then kind of explain why we chose to do this study. So the motivation of our study is to focus on the Chinese expansion in the global infrastructure market. As we've discussed, it is very important because China has been making um, global infrastructure investment, and these have been falling short by around 0.35 to 0.37 billion trillion US dollars per year. And from 2013 to 2021, the US Government Accountability Office suggested that China provided 679 billion for infrastructure projects in transportation, energy, and three other sectors, whereas comparatively, US provided only $76 billion in the same sector. So you can see that China is filling that gap for countries, whereas US is now kind of US is stepping back, taking a back foot in investment in infrastructure projects. So we also then talk about the controversy surrounding China's overseas infrastructure investment. So it is not free from controversies, as we all know. There have been issues of debt sustainability for the host country government. So media accuses China of playing the debt trap diplomacy, in which economies essentially borrow and build economically non-viable infrastructure projects, and eventually then China takes control of these assets when the debtor country run into financial problem. So one example of this is the Sri Lankan airport example. So in 2014, China invested in a Sri Lankan airport. It was a $209 million Chinese $1 million project. And however, according to government data in 2014, the average number of passenger traveling per flight was incredibly low. So it was 7 passenger per flight flying. So this means that obviously it was a lot of money spent on that project for no usage or no passengers traveling in the area. So economically it wasn't a viable project, and therefore these kind of projects are ruining China's reputation, let's say, in the um, as a as a country that is that allows that takes host country into a debt trap. Similarly, transparency is another issue. So Chinese government is not that transparent. Um, China is usually unwilling to report any bad news, and that kind of into misrepresentation of data. So we don't really know why projects are awarded to state-owned companies, or why projects are awarded to one firm rather than the other. There is no clear-cut process. Government is making these deals, and obviously there is low transparency, and that is an issue. Then another controversy is environmental issue. Um, for example, in mining contracts, in mining projects, that may lead to destroying ecosystems or forest, or if there is a hydro project, that may lead to relocating people. So these are kind of issues which China needs to deal with, and then again social responsibility as well. China needs to make sure that they are more socially responsible. So these are the issues that China is currently facing, and then we also have to look at the cost and benefit for the host country, which is inviting foreign investment in its infrastructure. So the host country basically needs to understand what are their costs and what is the benefit for it to invite China. So this is an issue which is something which motivated us to um, again research this topic. So host country needs to know what are the costs, what are the benefits to invite foreign investment. And then another thing that we should note is that uh, China's model of undertaking overseas infrastructure investment is different to a normal Western or a mature market investment. So, for example, China is it's always state-owned investment. It's government-funded investment. So, finance is also provided by state-owned banks. The companies that are investing or that are going and doing the project in the host country are also government-owned. So, this is something which is different from the developed economies investment. So next, we briefly look at the China's motivation of China's investment in these three main regions. So in Africa, the motivation is mainly resource seeking. It's where the Chinese government wants some assets like natural resources from the country. So what they do, they finance the product, they finance their project with um, the Angola model. So they have a unique type of way of financing their project. So if the African host country cannot pay China money for the project, what they will say, okay, if you can't pay money, if you can't pay finance the project, we will take your resources and you can pay us in resources. So this is something unique that China is doing in Africa, which also allows Africa to be more to get more infrastructure investment from China. So this is one thing that they are doing. Then in Europe, the main motivation of China investing in Europe's infrastructure is technology seeking and market seeking. So it's mainly in the high tech sector and the energy sector. So they are learning about renewable energy, commercial aviation, etc. And financing is simple. It's public-private partnership, mainly undertaken by the Chinese state-owned companies. Then in BRI, which is a phenomenon that started after 2013. So the motivation of China's investment is market seeking, and it's mainly infrastructure projects in developing countries that are short of financing for infrastructure. For example, Pakistan is one example. Indonesia, Sri Lanka, etc. So their model of financing is again a different model, which is build, operate, and transfer. So a Chinese company agrees to build a public infrastructure project for the government. It then proceeds to operate and manage the facility for an agreed period of time. So that can be around 30 years or 40 years, during which it tries to recoup its outlay and start making money. And then after that time period has ended, the company transfers the ownership back to the public entity. So these are some of the motivation of Chinese investment in different regions. So now we come to contribution from our research. So in terms of the contribution, I think we will add evidence on the economic impact of China's infrastructure investment on host countries. Previously, the studies that we have seen are mostly case by case basis. So this is where we look at the economic impact and provide empirical evidence on that. So this is one contribution. Then the second one is a comparative analysis across Africa and non-African countries. So this is something new that we are providing. It's that comparison between African and non-African countries. We believe that there is a difference of the impact of investment on African and non-African countries. So basically, it matters what the host country is like. It matters um, where China is making investment. So therefore, the comparative analysis is something new that we are doing. And the third contribution from our research is the our treatment of the endogenous problem. We are going to look at we are making a supply side. We are going to use the supply side IV. And I think that this is something that we have borrowed from other literature, which I'm going to talk about in detail later. So, so yeah, this is something. This is a contribution that our paper is making. So, with regards to the literature review, the infrastructure investment theory is a basic. We are using a basic the economic growth model. So the core literature is about infrastructure investment theory. So where one point of view suggests that infrastructure investment creates jobs and supports the private sector, whereas other suggests that public capital can be a substitute for private capital and it decreases the overall economic productivity. And then with regards to foreign investment in host country literature, um, we we look at this paper where they allow private firms to invest in host country infrastructure in the form of PPP, and they believe that they can increase GDP and welfare of the host country. So they can do that through accumulating host country capital stock, promoting private sector activities, increasing host government revenues. But they also suggest that the net effect on host country depends on the bargaining power of the host country government. So again, it depends on what the host country government is thinking about, how it is distributing revenues that are collected from the project. And so the impact of the positive impact also depends on the host country government and their bargaining power. So Then we also, the second substream of literature we look at is the studies on BRI infrastructure project. So we have the World Bank report which suggests that um, so they empirically estimate the impact of transportation project among the BRI corridor based on different economic models. And overall, they make an overall conclusion that BRI transport projects can expand trade, increase foreign investment, and reduce poverty by lowering trade costs. So, but for some countries, the cost of new infrastructure could outweigh the gains. So basically, they also report a positive impact of um, foreign infrastructure investment. Then the second study, they also look at, they consider two impacts of transport infrastructure projects on host countries. So they look at shipping times in trade and public debt. So in terms of shipping time in trade, they find that transport infrastructure increased GDP for Belt and Road recipient countries by up to 3.35%, and welfare up to 2.81%. And they also find out that BRI related transport projects could increase welfare for the non BRI neighboring countries and also the world. So the positive impact kind of uh, is spread over across to neighboring countries and beyond. Okay, so studies on African infrastructure project, there are few studies which focus on China's infrastructure investment in Africa. So both these studies, one is a case study on Kenya, which demonstrate that China's infrastructure project have reduced transportation costs and enhanced trade efficiency. And the other also suggests that transportation networks have been improved, leading to reduced logistic cost and making better market access. So another important substream of literature that we are looking at, it concerns the differing impact of China's infrastructure investment on recipient countries. So infrastructure investment in countries with already well-developed infrastructure may not yield the same growth benefits as those in countries with significant infrastructure gaps. So, for example, the first study that we find, um, they find that the effect of infrastructure investment differs in developed and developing economies. So, what they do is they use um, gross fixed capital formation, and they use two types of gross fixed capital formation. One is infrastructure gross fixed capital formation, and the other is um, um, other type of capital formation, which is spent on other types of investment. So they find that in developing economies, infrastructure gross fixed capital formation investment has a greater relative impact on output than other types of gross fixed capital formation. And as compared to developed economies, the returns from infrastructure is relatively lower when compared to other forms of capital. So basically, when they compare developed and developing economies, they find that the returns from infrastructure investment is greater than the returns that have been made in the returns from infrastructure investment is greater in developing economies than the returns from infrastructure in developed economy. So again, this is the differing impact of the region where China is investing. If they're investing in developing economy, then the returns are more. And if they're investing in developed economy, the same growth in return is not attained. The next study is basically Fernald, who says that repeating investment in roads would not yield the same productivity increase as the initial investment. So we know kind of from US example as well, once initial roads network or initial infrastructure is developed, then a similar growth rate for additional infrastructure is a bit difficult to achieve. So, and the last study, they examined the impact of energy infrastructure on regional economic growth using data of China's power grid between 2000 and 2014. They find that, so this evidence is from China, and they find that power grid infrastructure offer greater marginal benefits in less developed regions than more developed coastal regions in China. So again, kind of reinforcing the theory that if there is, so reinforcing like the fact that if existing infrastructure is developed, then the marginal benefit of more infrastructure on economic growth is lesser as compared to less developed infrastructure, less developed regions. Okay, and then we also here we have China's infrastructure investment as a percentage of host country GDP. So the main point I wanted to make with this chart is that the China's infrastructure investment, so in blue we have Africa, and in gray we have BRI, and in orange we have Europe. And we can see that China's infrastructure investment as a percentage of Africa's GDP is quite a lot. So it will have more impact on Africa than Europe or BRI. So basically, the infrastructure investment that we are making in Africa, that China is making in Africa, would have a greater impact than other economies where the investment is low as a percentage of their GDP. So moving on from our literature review, we now discuss the empirical model and the identification strategy. So here we talk about the IV we are going to use. And we are doing instrumental variable analysis. And these two equations are obviously the first equation is the first stage analysis, and the second equation is GDP growth, the impact of China's infrastructure investment on growth. So the standard approach to address the endogeneity problem is to identify an instrumental variable, which is highly correlated with endogenous variable, which in our case is China's infrastructure investment, but not with the growth, which here is GDP. So other than via China's infrastructure investment. So the standard approach, I'm going to just repeat that. So the standard approach to address the endogeneity bias is to identify an instrument variable, which is highly correlated with the Chinese infrastructure investment, but is not correlated with the growth of the host country. But if we look at the recipient country characteristics, they will be, if we use recipient countries characteristics, they will likely be correlated with growth. So therefore, we think that cannot serve as a proper instrument. So we therefore follow a different approach, and we use a supply side instrument based on exogenous variations in China. So we follow this literature, which is mentioned, Dreher. We follow Dreher and Langsdorff, which is mentioned in the last point. What this paper did, they looked at the effect of foreign aid on economic growth. So what they did was they made use of the relationship between fractionalization and government budget. What their point of view was that in a coalition government, there will be a coalition government which is made of many groups will be more reluctant to reduce expenditures compared with the single party government, as each party of the coalition will resist pressure to cut expenditure in its own area, even if they are in favor of overall spending. So, therefore, fractionalization of governments will lead to larger budgets and also increase aid budgets, which in turn will affect aid disbursement to recipient countries. So they argue that the government fractionalization in donor country is excludable in growth regression at a recipient country level. So basically, they think that fractionalization is not related to the host country growth. So therefore, that becomes kind of a supply side instrument, um, which which is supply side instrument which is not related to host country growth. Then they interact this variable with the probability of receiving aid as their instrument. So they interact fractionalization with the probability of receiving aid and make that their instrument. So we use a similar approach. What we use is China's total social finance as a supply side instrument. So this total social finance refers to the total volume of funds provided by China's domestic financial system to the private sector of the real economy during a year. We use this instrument because it is highly correlated with China's overseas investment in two aspects. So one is that it is associated with manufacturing activities in real economy. So more real activities support the Chinese government revenue, some of which will directly support the state-led overseas infrastructure operations. And the second reason is that it is a measure of liquidity of domestic financial system. So high liquidity means low interest rate, which facilitates the financing capacity of the banks, of the Chinese banks that are investing in overseas infrastructure or providing loans to the overseas infrastructure to the host country for investment. So therefore, we think that this IV is relevant. It is highly unlikely that, however, it is highly unlikely that this total social finance can directly affect host country GDP or host country growth. So therefore, it is a supply side instrument which do not affect the growth of the host country. Now, again, we also have to interact this total social finance with the probability of receiving China's infrastructure investment by the host country in each year. Yeah. So here we we create a probability of the host country receiving the investment by taking the ratio of China's infrastructure investment received by the host country in year T to the sample of total China's infrastructure investment in year T. So this is denoted by PEIT here, and then China's IV is interacted with PIT. And in the first equation, which is the first stage equation, we look at, we use this interaction, and the dependent variable is China's overseas infrastructure investment. And then we use that dependent variable in the second stage. In the second stage, China's overseas CHFDI hat, and we look at the regression of how that impacts GDP growth. So now we come to the measurement of these variables. So the measurement GDP growth per capita of the host country. GDP is the GDP growth of per capita of the host country. China's CHFDI is the natural log of Chinese overseas infrastructure investment as a percentage of GDP. And then we also have several control variables like trade, which is net export, less imports from net export to China of the host country, and then natural resources, which is also taken as a natural logarithm. Economic freedom is an indicator of the economic freedom of that country. It is we take the natural log of this variable as well, and existing infrastructure is denoted as infra, which is telephone subscription per 100 people. So the data we have, all the host country information is taken from the World Bank and International Monetary Funds. And for the China's overseas infrastructure investment, we have already discussed this data. It's from Chinese Global Investment Tracker, from American Enterprise Institute and the Heritage Foundation. We have identified 1,802 Chinese construction contracts from 2005 to 2022, and the sample covers 118 host countries. 46 are Africa, and 72 are non-African countries. So now we discuss the empirical results. So this is our first stage estimation with the total social finance IV. So INS is the IV interacted with the probability of receiving investment. So we take lag 1 and lag 2 of these instruments, and the dependent variable for our first stage is China's infrastructure investment. And if we look at the 3 columns, one is the main sample, the second column is Africa, and the third column is non-African countries. So for all 3 columns, we can see that both instruments are statistically significant at 5% level, which suggests that these instruments are valid. And we move on to the second stage results. Here again, we look at the dependent variable in the second stage is the GDP growth, and there are 2 excluded instruments used, which we showed you in the first stage results. So these are lagged 1 and lagged 2 of the supply side instrument interacted with probability of receiving investment. And then the main results are that China's infrastructure investment is positively and statistically significant for the main data and Africa, but it is not significant for non-African countries. So basically, this suggests that the China's infrastructure investment is generating the growth effect in overall growth effect in all the countries combined and in Africa, but it is not generating the same effect in non-African countries. So we also do another robustness test. So in the first estimations, we use total social financing as our IV and as an indicator of the liquidity of Chinese financial system. So in the robustness test, we follow another study, and which is mentioned here, IOKELA 2021. And we select an indicator that reflects China's real economic activities, which is China's steel production. Again, we feel that um, steel production increases as Chinese infrastructure investment increases. So Chinese infrastructure investment in the host countries, this variable is a direct kind of indicator of an increase in Chinese infrastructure investment in host countries. So if you think about when China is investing more in host countries, the steel production will increase, and if it is investing less in the host country infrastructure, so, this variable will um, this sorry variable will decrease. So therefore, it's again a supply side instrument, um, which which will impact China's infrastructure investment, but will not impact host country GDP growth. And then we interact, similar to the last example, we interacted with the probability of host country receiving China's infrastructure investment in the corresponding year. The empirical results for the first stage is again, um, um, we have both IVs, lagged 1 and lagged 2, IV steel, and both in all our subsamples, in all our main sample and the subsample in all columns, it is statistically significant. So that means that our instrument is relevant. And in the second stage, again, we find similar results to our to um, to when we were using total social finance as our IV, where Chinese infrastructure investment is generating a growth effect for the main sample and in Africa, but in non-African countries, it is not generating the same effect. So now we move on to kind of the summary of the results. We find that overall growth impact of China's infrastructure investment on host country is positive. But when we distinguish the effect between African and non-African countries, we uncover that positive growth effect only exists for the African host country, but not for non-African. We believe that, according to theory that we have discussed in the literature, we believe that this effect is because of Africa's infrastructure gap. So because in Africa there is a lot of infrastructure. There are a lot of studies which suggest that Africa has an infrastructure gap, and therefore infrastructure investment in Africa is generating a greater growth effect than in other countries where the gap is not as high. So as we discussed earlier, once infrastructure investment has been made, a growth in returns from the same type of investment would be difficult to attain. Now we move on to the policy implications. Our research can be useful for international policy makers, such as government from developing countries, if they are thinking about making an infrastructure deal with the Chinese government, etc. Meng and I were having a discussion before starting this presentation, and she was also suggesting that a lot of people or a lot of policy makers from Africa are interested in finding studies that are actually giving them evidence rather than just you know saying that this is happening. So evidence is very important, and when our study is kind of giving that evidence, and therefore it can be interesting for the policymakers. And then our study is also providing that regional specific factor which can aid host countries to perhaps negotiate with Chinese government in terms of future deals. So that is all from my part. Thank you very much for listening to me patiently. And I welcome any contribution that you can make for us to make this paper better, make it more publishable. So please do give your comments on this. Thank you.
Thank you very much, Alina. So you said we were patiently listening to you, and you actually were very patient when you do your presentation. You explained very calmly and in detail. So I think we have got a clear picture about what you have done. We have done in this paper, but you talked about it with a focus of motivation and also the methodology, I think. And I think the paper, so we have seen so many papers in this type of growth model. The most famous problem in this type of empirical research is the endogeneity problem. So I think the contribution of this paper is to use the supply side IV. First of all, conventional IV is already very difficult. I have to take care of this. So normally, if we solve the endogeneity problem, we want to use an IV approach. And that IV, in a conventional approach, that is taken from the object that we are studying, so host country in this case. So the difference between the IV that is used in this paper and the conventional IV is that you are taking something from the supply side. So in the literature, they use the aid. So the donor is the supply because they supply the capital aid to host countries. In this case, it is China, supply side is the China because China is supplying infrastructure. So I think that is a very, very good contribution. And so you mentioned that when you use IV, you have two IVs, and one is total social financing, which is directly related to the financing of infrastructure investments, because one feature of Chinese investment in infrastructure is to provide the finance at the same time. So that is very good one. And the second one is the steel production. And that steel production, I think you forgot about the one key word, and that is overcapacity. So China has already accumulated a lot of steel production. So overcapacity actually is one of the reasons why China started the BRI and started to actually export, to make use of those overcapacity in other countries. So steel, among all other construction materials, I think steel is the famous one, the representative one. So I think that's why we choose that one. And I think it's mainly about the export of overcapacity from China's perspective. So I think that is very good. I think we should let people know that this is a very good contribution from the methodological part. Although we see the general approach, supply side, we did not see that was applied to this specific topic. So that's a very good one. And I think at the end of your results, you actually you found some differences between Africa and the non-African host countries. I think that makes sense, but I think the paper probably should continue and to provide some evidence to justify whether indeed it should be the infrastructure gap or it should be some existing infrastructure. So you can go a little bit further from now and to provide some evidence to make the connection between your empirical research and the the underlying theories. And the theories now is related to your argument, and that is the infrastructure gap. So between developing countries or less developed countries and the mature market economies. So that's my comments. That's my overall reaction. So I'm going to open the floor to the two colleagues, and I'm sure this is a very interesting topic itself, but in addition, methodological things. So I think those are the current issues that people are seeing quite a lot in journal papers. Who can start? Who has a hand? I have not seen any hand today. Any questions or comments about this paper? Oh, Richard, thank you, Richard. Richard, please, yeah.
Okay, excellent paper. I think in terms, 2 days ago, I wouldn't have had any ideas how you might improve it. But I think that, or a week ago, but I think given the announcements that we heard, first of all, from the UK government, that they're cutting back international development aid, and then yesterday, President Trump made a speech in which he had very strong words for. He was very hostile to U.S. investment, U.S. aid to Africa. He called it a waste of money. He said that some African countries had received aid unfairly, and he referred to one African country as, quote, a country nobody's even ever heard of. So, given that Africa has an infrastructure gap, given that it has been confirmed that it cannot look to the West for assistance with that, it only underlines the role that China's going to play. And if you want a useful quote from that, there's one from 2023, I think, a BBC journalist, Laura Trevelyan, talking about the Caribbean, where she said China is providing the investment that these countries' former colonial masters are not. So I think that might be a slant you might take, that the West is backing away, and that makes Chinese investment all the more valuable.
Yeah, I do agree with that. Thank you for your comment. And I think that, like we've already discussed, that the West is not investing a lot in Africa. They've forgotten Africa. They don't really care about it. But China was already investing a lot in this region. So they in America, with Trump's announcements, etc., I think it will have an impact on Africa, but not a lot, because already China is there. They have projects going on. They have everything set up there. And they are willing to invest more as well. Whereas America, they've been trying to catch up with resource seeking, etc., but it's not really a lot anymore, and it's not really working out for them. So therefore, I think it's interesting to see what Trump says in the future, and to kind of keep an eye on what America is thinking. But for now, I think for Africa, this is not going to impact Africa a lot, because China is already there and is already investing more than America.
Okay, thanks.
Thank you very much. And yeah, so any other questions or comments? So I think Trump is very busy now, so has no time for China at the moment. So anyway, so any other questions? So any other thoughts, any other further suggestions for further improvement? Very quiet today. And I think I'm clear, but one thing that probably Alina, you can just share a little bit. So you know that you use a supply side variable, IV, and then you interact that variable from China side with the host country, the probability of host country receiving China's investment. And so can you explain a little bit more, why do we need this interaction term? Why do we not just use a supply side variable?
Okay, so because supply side variable doesn't change according to the times and according to the host country years. So basically what happens is that you need a probability of investment to change the supply side IV. So the supply side, for example, we take total social finance investment, and we use that in 2005. We divide it by China's GDP, and we use that in 2005. Then we take the supply side, total social finance for 2006 and divide it by GDP, use it for 2006. But those variables, they're going to remain the same throughout the data. So for any country, it's going to remain the same. So for Africa, Afghanistan, for Pakistan, for all these countries, 2006, 7. So the supply side is going to remain the same. So we need an interaction term, the probability of a country receiving that investment, in order to make sure that it changes according to that country and according to the year of investment. Sorry, you're still mute, Professor Bo.
Yeah. So now I see where you are coming from in terms of this, and that was the aid paper has done, I think, the similar idea, but we use this for investment instead of aid. Yeah.
Yes.
Great. Yeah. And that's okay. That's fine. Thank you. And do we have any other questions? No? Oh, Richard. Oh, you need to go. Okay. So please, thank you very much, Richard. Thank you. So, if Alina, do you have anything to say? It looks like oh, Jeffrey. Jeffrey, can you come in, please? Yeah.
Yes. Thank you, Hong, and thank you, Alina, for your interesting presentation. I just have a little comment. I noticed that you measure your dependent variable as the natural log of infrastructure investment, expressed as the percentage of GDP. So it looks like you have combined both measures. So I'm not sure why you decided to measure it that way.
Okay, so it's a GDP of China. It's not host country GDP. So you're talking about the Chinese infrastructure investment variable?
Yes, because your definition, where you define it here, you said it's the natural log of.
We have just scaled it to a percentage of China's GDP. So just in order for the estimations to be, clearer. So it's not host country GDP. This is percentage of China's GDP.
Okay. Because I mean, I'm just trying to know. I haven't seen this measure before, where you express this as percentage of GDP, then you take the natural log. But thank you.
Yeah, sorry, I'm taking down the note. And any other questions? The colleagues, why do we have any other questions? Yeah, no. So Alina, so I think we had a very concise paper and a concise session. So since we do not see any hand, so why don't we finish this session so that we can do something else. So thank you very much, Alina, for coming, and I give you just a half minutes to finish it.
Well, thank you very much, everyone. Please let me know if you have any other concerns or questions about the paper or any ideas. If you think about it later on, please email me or email Professor Bo, and we would really want to get this paper, running. We would really want to publish it, and any comments, any contributions would be really appreciated.
Yeah.
And thank you all for listening again.
Thank you very much. Thanks, Alina, and thanks the colleagues for your time and to be here.